In the summer of 1994, a 30-year-old Wall Street quantitative analyst named Jeff Bezos sat in a garage in Bellevue, Washington, surrounded by knee-high stacks of books. Outside, the world was on the cusp of a digital revolution that few truly understood. The internet was a niche curiosity, a playground for academics and hobbyists. Yet Bezos had spotted a statistic that changed everything. Web usage was growing at 2,300% per year. He realized that this was not just a new medium for communication, but a complete restructuring of human commerce. He chose books as his first category because there were more individual items in the book industry than in any other category, making it impossible for a physical store to stock them all. Today, that garage project has evolved into a $2 trillion titan that handles nearly 40% of all online retail in the United States. To understand how Amazon reached this staggering valuation, we must look beyond the cardboard boxes and the Prime delivery vans. We need to examine a relentless economic engine that redefined the relationship between profit and growth, destroyed traditional retail models, and built the digital backbone of the modern world. Stay until the end to find out how a company that once lost billions of dollars every year became the most dominant force in global capitalism, and whether its current trajectory is sustainable or a looming regulatory disaster. To appreciate the scale of Amazon's rise, we have to look back at the economic landscape of the mid-90s. The retail industry was dominated by massive brick-and-mortar players like Sears, Kmart, and the undisputed king Walmart. These companies operated on the logic of physical footprint and geographic proximity. If you wanted a product, you went to the store that was closest to you, and that store's inventory was limited by its square footage. There was a massive inefficiency in this model, known as the search cost. Consumers spent time and fuel looking for items, and retailers spent enormous amounts on prime real estate and local inventory management. When Amazon launched its website in July 1995, it didn't just open a store, it opened an infinite shelf. By the time of its initial public offering in 1997, Amazon had only 514,000 customers and generated $16 million in annual revenue. At that point, the company was hemorrhaging cash, recording a net loss of nearly $6 million. Traditional economists were skeptical, viewing Amazon as a dot-com bubble darling with no clear path to profitability. However, Bezos was playing a different game, focusing on a concept he called the flywheel effect. This was a virtuous cycle where lower prices led to more customer visits, which attracted more third-party sellers, which led to a larger selection, which improved the customer experience, and ultimately allowed for even lower prices through economies of scale. The primary economic problem Amazon faced in its first decade was the brutal reality of logistics and the last-mile delivery. While it was easy to list 1 million books online, it was incredibly expensive to store and ship them. Between 1994 and 2003, Amazon did not turn a single penny of profit. In fact, by the end of 2000, as the dot-com bubble burst and tech stocks plummeted, Amazon's accumulated deficit was over $2 billion. Critics called it Amazon.toast, arguing that the company would run out of cash before it could ever reach the scale needed to compete with Walmart's purchasing power. The risk was existential. If Amazon raised prices to become profitable, it would lose its growth momentum. If it kept prices low, it might go bankrupt. This period saw the first major trigger event, the launch of Amazon Prime in 2005. At $79 a year, Prime was an economic gamble. The shipping costs for a heavy user would far exceed the membership fee. But the data showed something transformative. Once a customer paid for Prime, their switching costs became high. They stopped price shopping on Google or at local stores and went straight to Amazon to get their free shipping. This locked in a massive base of recurring revenue and gave Amazon the predictable volume it needed to invest in its own massive network of fulfillment centers, further pressuring traditional retailers who couldn't match the speed or the cost. The deeper analysis of Amazon's $2 trillion valuation reveals that the company is actually two very different businesses joined at the hip. While the retail side provides the volume and the data, it is Amazon Web Services, or AWS, that provides the fuel. Launched in 2006, AWS was a radical departure from selling books. Amazon realized it had become experts at managing massive server farms and decided to rent that infrastructure to other companies. This moved computing from a capital expenditure, where a startup had to buy its own servers, to an operating expense, where they simply paid for what they used. The economic impact was profound. AWS democratized tech entrepreneurship, allowing companies like Netflix and Airbnb to scale without owning a single server. By 2023, AWS occupied over 30% of the global cloud infrastructure market. More importantly, while the retail division often operates on razor-thin margins of 3 to 5%, AWS enjoys operating margins of roughly 30%. In many quarters, AWS accounts for over 60% of Amazon's total operating income, despite representing only 15% of its revenue. This quote 5 allowed Amazon to continue undercutting competitors in retail for decades. Furthermore, the company moved toward vertical integration on a scale rarely seen since the days of Standard Oil. Amazon now owns its own planes, long-haul trucks, and thousands of last-mile delivery vans, effectively competing with FedEx and UPS. This reduces their reliance on external logistics partners and gives them total control over the data of every transaction. In 2023, Amazon's total revenue reached $575 billion, a figure larger than the GDP of many developed nations. The outcome of this relentless expansion has been a total restructuring of the American and global economy. We now live in the era of the _6_, where price transparency and two-day delivery are the baseline expectations for every consumer. This has led to what many call the retail apocalypse. Over the last decade, more than 50,000 retail stores have closed in the United States alone. Iconic brands like Toys R Us, Sears, and Borders have vanished or been reduced to shells of their former selves. The winners in this scenario are undoubtedly the consumers, who enjoy lower prices and unprecedented convenience, and the shareholders, who have seen Amazon's stock price grow by over 2,000 times since its IPO. If you had invested $1,000 in Amazon in 1997, it would be worth over $2 million today. However, the losers are also clearly defined. Small independent businesses find it nearly impossible to compete with Amazon's logistics and data advantages. Workers in Amazon's fulfillment centers face grueling conditions, with some reports indicating employees walk over 15 miles per shift and turnover rates reaching 150% annually. There is also a growing concern about the quote, 7 power Amazon holds over third-party sellers. These businesses are often forced to use Amazon's advertising and fulfillment services to remain visible, effectively paying a quote 8 to Amazon to reach their own customers. This has caught the attention of regulators at the Federal Trade Commission, who argue that Amazon's dual role as a marketplace owner and a direct competitor creates a fundamental conflict of interest that stifles innovation. The ultimate lesson of the Amazon story is that in the digital age, scale and data are the ultimate competitive moats. For investors, the takeaway is clear. Long-term thinking and the willingness to sacrifice short-term earnings for market dominance can lead to astronomical returns, provided the company is building a network effect that becomes more valuable as it grows. For business owners, the lesson is the importance of customer obsession and vertical integration. By owning the infrastructure of their industry, from the servers to the delivery vans, Amazon made itself indispensable. However, for the broader economy, the Amazon case study serves as a warning. We are seeing a shift toward a _9_ economy, where a single entity can dominate multiple sectors simultaneously, from grocery stores and healthcare to Hollywood production and cloud computing. This raises critical questions about whether our century-old antitrust laws are equipped to handle a company that keeps prices low for consumers while potentially crushing competition and depressing wages. As we look toward the future, the debate will not be about whether Amazon is a successful company. Its $2 trillion market cap answers that, but whether its dominance is healthy for the long-term vitality of the global marketplace. The bottom line is that Amazon didn't just win the game of e-commerce, It rewrote the rules of the game itself, and now the rest of the world has no choice but to play along. Let me know your thoughts in the comments on whether you think Amazon's dominance is a net positive for society or a monopoly that needs to be broken up. This video is for educational purposes only and should not be considered financial advice. Always do your own research and consult with a qualified financial advisor before making investment decisions.